Yeah, certainly nice to be with you again. It's been a really tough year, worst year for bonds on record. As Bob just mentioned, down 20% or so on the S&P 500. That's the worst since 2008. So I think everyone's just really looking forward to getting out of 2022 and seeing what 2023 might bring for the investors.
Right, but I think you're even more hawkish than some of the hawks here. I mean, very few people think the Fed's taking the Fed funds rate all the way up to 6%. Why do you think they will do that?
Yeah, I think some of this inflation is just a lot stickier than people might think. Historically, they've got to bring their Fed funds rate above where the CPI is going to be living. And so if we get a couple of bad reads in the first couple of months, inflation's a little bit more sticky than they think. I mean, they've been determined to crush the demand side of this economy. So I think they would have to bring rates up a little bit higher than people think, not drastically higher. We've already come a long way. But I think the bigger prognosis is that the rates will be higher for much longer than people think.
Yeah.
And so we're going to hang out in an environment with rates at 4.5%, 5% for potentially years, because I don't think the Fed wants to repeat the 1970s mistake of lowering rates too early and then seeing inflation spike back up again.
Well, and you're a wealth management firm. Your clients are trying to protect, if not grow their wealth. If you're thinking as hawkish as you are about the Fed crushing demand and raising rates and all the rest of it, where are you putting client money? I can't imagine it's in the stock market.
Well, we're long-term investors, Kelly. So we have an allocation to stocks. We are not market timers, and so maybe we take our stock allocations down and we get more defensive. We invest in dividend-paying companies, and we are kind of avoiding the no growth, no profitability companies. But to your earlier point, Treasuries at 4.5%, those look pretty good. I think the biggest mistake investors are making right now is they've got tons of cash sitting in bank accounts that's yielding 0.25%. I mean, they're leaving so much money on the sidelines by not putting their money in some treasuries or more of a high-yielding money market. I think that's a huge opportunity that some investors could take, right now.